All right, welcome back to Robinhood's Stock Market Watchlist Facebook group. My name is Carlos. I'm the creator and administrator of our group. And today is January 9th, 2022. On Sunday, we have a weekly meeting every Sunday where we go over, well, the first hour, we always kind of go over the advanced basics, which really helps provide a lot of us, great information. That way we never forget. Always, go over the basics, which is always important. So that way we have a very strong process. After the first hour, we always kind of look to see what the next week is going to look like. So if this is a recorded live session, so you can always skip ahead to the first hour if you need to look at what this week is going to look like, and that way we can kind of plan ahead, knowing what day is going to be bearish, what day may be bullish, as well as going over many other reports and a lot of stuff. So but like I had mentioned, the basics are always the fundamentals of any type of investor or trader. And so the main thing that every investor and trader needs to really master before anything else is advanced charts and graphs. Every type of investor, whether you're a long-term investor, short-term, or maybe you're a swing trader, day trader, or maybe in the cryptocurrency, they all use something called moving averages, which are in a lot of different stock market applications, but it might not be in certain ones. Like if you're just using the Robinhood app, which is a great and powerful tool, has a really nice, clean user interface, but it does lack a lot of advanced tools that you really need if that's the only thing that you're using now. And so I use Robinhood as well as Webull, but a lot of people may use like TD Ameritrade or E-Trade or whatever. As long as you have something that provides your moving averages, that is extremely important. And so I'm going to pull up a couple of videos that we'll watch, and that way it'll kind of explain what moving averages is, as well as how it can be a huge advantage for you, because it really provides you your buying and selling signals. It really provides that ultimate question that you hear a lot: should I buy? Should I sell? This is like having an assistant that tells you that kind of information, as well as if the stock is trending upwards or downwards, or what it may do pretty soon. Because there's just a lot of great information that it provides, and if you're not using it, that means you're using the hope system, where you're just throwing money at something hoping that it sticks. So I'm going to pull up this video here really quick. Give me a moment while that loads.
The moving average is one of the most commonly used technical indicators. If you've spent even a little time looking at price charts, you will have noticed that most often the price of an instrument will move up and down. In fast-moving markets, you may find that the price may be surging up only to plummet moments later before surging up again, increasing the potential for false signals. The moving average can help filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available, in this way ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods: 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you're analyzing a fast-moving market, as you'd have more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction. Thank you for watching this tutorial on moving averages.
All right, so we're going to switch over to Webull, and we're going to show you some live examples, but also how to configure the moving averages for your preference. Because like I said, there's many different styles of investors and traders, and whether you're a long-term, short-term, swing trader, day trader, it just depends on that. And so if you're more of a long-term investor, you're going to want to configure your moving averages according to that, or so that way the moving averages doesn't react as quick to that, because the false signals is basically you're getting too many buying and selling signals, and if you're long-term investors, you don't want that. You know, if you're a day trader or a short-term or a swing trader, you're going to want a more reactive moving average to provide you your buying and selling signals. That way you can get in and get out, you know, really quick. And so that's what my graphs are currently set up for, is being able to react towards these price movements, and for optimized for day trading and swing trading. So I use EMA for the primary indicator, and if you're on the desktop application, you just click on the on that, or if you're on your mobile application, you can just click on it too, and then the little gearbox icon appears. That's your settings icon. So then you can click on that, and then you'll have your indicator settings right here as your main chart. Most people are going to use either the MA for your regular moving average or the EMA. but you can try out many different ones. Now you have lengths over here. We have by default 5, 10, 20, 30, 60, 120. These represent like trading days or maybe minutes. And so a 5 trading days basically represents 1 week moving average. And then you have 10 trading days, which is a 2-week moving average. And then 20 days is your 4 weeks or 1 month moving average. But maybe you want to do your 20, 30, or 60, or 30, 60, or 120. Now, if you're looking at it by like a 1-minute chart, this would be like a 5-minute moving average, 10-minute, 20-minute, and so on. So it just kind of doubles whatever time frame that you have set up on. Now, when you click on Style on the top here, this is where you can configure what lines that you want, and just check out the difference when we select the 30, 60, and 120 compared to what it was. Now, you just don't see a whole lot of crossovers and whatnot. It's just kind of we're looking at Apple. Apple's just been kind of trending, upwards for quite a while, for the last year. And so that's what you want to see for a long-term investor. You don't want to see a lot of ups and some downs. This is just ups, and then it kind of goes straight, and then it kind of goes up again, and a little bit of straight, and up again. And so a long-term investor, that's what you want to see, and that's what the whole system here is telling you. It never provided a solid sell signal yet, but it got pretty close. And so now I use lines, where a lot of people will use, if you right click on it, another menu will appear. You can change your line style to like candles, if you like looking at candles, but it does provide me a lot of the volume information here on Webull. So it does provide similar information, but I need a clearer picture. You can kind of see how kind of fuzzy it can be. It takes a little while to get used to, but I just like a much clearer a picture. I do find without candles, don't need it. And so why fix something that's not broke? And so let's go back to the settings here. We'll change that back really quick. And then, but you can also change the colors as well to your preference. Now the subcharts, you can select up to 6. Now most of the successful and professional investors and traders will primarily use some kind of moving average like this along with MACD. MACD is extremely important to use along with that, maybe some other things if you want, but these two are the most important graphs. Now the MACD, which is on the bottom, provides 2 moving averages, average lines, and then these colored bars here represent gap distances between the 2 moving average lines. So it does help provide you a little bit of information for the system, letting you know, if it's uptrending or downtrending. And sometimes it can provide you some information a little sooner. So like, for example, as we're waiting for a crossover here, because this is as the price line for Apple comes down through the moving average lines, that's providing your sell signal. And then the last signal is when the 3 moving average lines crosses over each other. And then the price is continuing to come down. It doesn't know for how long or for how far it's going to go until further notice. And so it's providing you that notice right here, where the moving average lines on the MACD is now kind of crossed over each other. We see it went from red to green right there before it did that on the main chart. But we can see that we have a lot of buying activity here in this area as it now begins to move upwards. It provides you that trending indication that it's getting ready to come up, and it did. So that's your buying signal right there, and it continues to ride up. Kind of goes flat right here, and you can kind of see that right here. That's kind of a little bit of a false signal, so you have to listen to both of them. It's communicating with us, and so it basically says just hold on, just wait, hasn't crossed over yet, don't panic. And then as long as you held, you just continue to hold, ride the wave until it provides you a full solid sell signal, which almost looks like which is happening right about now. Once that, which is the price line is cut through all three moving average lines, and then the moving average lines are just about ready to cross over. The last 4 days have been very red, so there's been more selling activity than buying activity. So so it looks like, and the timing is perfect because we've entered the winter season, which is the bearish season. It's the first quarter. It's the bearish season of the entire year. So you know, until probably sometime mid-March, this is obviously, it should come down somewhat. Don't know for, you know, how far it's going to come down, but I anticipate mid-March is the time where it'll start bouncing back. And so but you know, we'll see what happens. But like I said, the timing of everything, and as well as looking at things like this, it is absolutely crucial to master this stuff. And but sometimes you might not want to do it when the market is open, because to me, when the stock market was open, it was like a Super Bowl or something. I mean, it was like, you know, it was like game time. You had to have been practiced, you had to have been on your game, ready to go. And it's not a good time to practice. So how do you practice when the stock market isn't open? And so one day I was like, aha, I have a great idea. I'll be able to use moving averages on things like cryptocurrency and maybe trade using Robinhood. And so because cryptocurrency is available 24/7, it's available right now, or weekends, on holidays, early in the morning, you know, late at night, you know, right before bed. We can day trade cryptocurrency without any limitations. It has unlimited day trades without any dollar amount. You can trade $1, $10, you know, $100, $1,000, you know, whatever. You know, as long as you're trading some kind of money, you know, that's affecting you psychologically, which is part of your training, is to be able to be aware of your emotions and those impacts that affect your buying and selling decisions. And so the more you practice, you know, practice makes perfect. And so it's going to build more confidence. The more confidence that you have, the better trader and investor you're going to be. And so it was just a brilliant idea to be able to do this. And so when you're starting to day trade and practice these moving averages and buying and selling signals, it usually takes about 1 hour. You know, you'll see your buying signal, you buy, and then 1 hour usually later, maybe a couple hours later, it may provide your selling signal, and then just kind of get in and out, just practice, you know, doing it that way. It's a lot more mellower because it doesn't have an open and close, and that's one of the reasons why it makes stocks so volatile, is because it has an open and a close. The first hour and the last hour are the most volatile times of every day. And so let's go back to the video here. I'm going to point out one thing in the video, and then we'll move into the second video. But there's something, let me see if I can find it here, that is extremely important, is right in here. When you see a crossover, you have to mentally picture your buying and selling signals. You have to do this in your mind. You put the little highlight, little circle there, and imagine a sell and a buy signal. Now, if you're into stock options, that even opens up more possibilities, because now a sell signal can be a buy signal for a put. So a sell, you can sell your call, buy a put, and then go down, and then you would buy a call but sell your put. So you can use it both ways. And so, or let's say you do a straddle, you know, you buy whether SPY or Apple or whatever that it is, you buy both a call and a put, you know, the night before, and in your holding, well, this would be your signal to sell your call, hold your put. Then you wait until then it provides another signal, and this is basically the signal to sell your put. Then you could buy a call. because you can just kind of keep doing it that way and be able to profit from both ends, or to maximize your gains or minimize your losses when it comes to straddling, which we can talk more about that here in a little bit. But I'm gonna pull up the second video really quick and answer any questions you may have. Just give me one moment.
We will now build on material covered in the first tutorial on moving averages, where we defined what a moving average is, the 3 types of moving averages, and how they are calculated. In this second tutorial, we will discuss how to use moving averages to identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video, where we showed you the most commonly used time periods when analysing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place 2 moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which 2 time periods you use, this principle will remain the same. To recap, a moving average is a lagging indicator that can help filter out the noise from random price movements to see the average value. It can help identify the trend direction, determine support and resistance levels, and can help confirm a trend reversal when looking at moving average crossovers. It is important to understand the differences between the types of moving averages and how to tailor the time period to best fit the trend being followed in order to gain the maximum benefit from this indicator. Thank you for watching this tutorial on moving averages.
Alright. Anybody have any questions about moving averages, or everything makes sense? You can feel free to unmute your mic. You can talk via voice, or you can chat in the Zoom chat room. if you have any questions. If not, we can move into patterns.
Okay, Mr. Carlos.
Yes.
Okay. So if I do 10 or 20 and both are crossing the line each other, so that means it might go up. So that means like buying signals. But what if sometimes I see that some of the stocks like that will like zigzag. It is so confusing that time. So in that case, what I'm supposed to do?
So if it provides, a lot of zigzagging, you may have to adjust the timing of the graph. Meaning where, like for example, if we did the 1 minute on Bitcoin, maybe, or there's not a whole lot of zigzagging on that one. Let me see, maybe Dogecoin provides a lot of zigzagging. But if you get too many little signals and stuff, you can smooth things out by clicking your 5 minute or 30 minute. If you add just more time to it, see, I still don't see a whole lot of zigzagging on that one. See, there's a little bit more on that one. So you just have to adjust the timing of the intervals until it becomes a little more clear based on your strategy and stuff. But if it's zigzagging and you're on a daily chart, then you may have to look at a different stock or something. But yeah, you just basically adjust the timing of it until it becomes more clear.
Okay, I understand. Okay, thank you.
And the other thing is too, when it does begin to touch some of these lines, once it has crossed over the moving average lines and everything and has its final signal, once it does begin to touch the first line, it does have usually a certain percentage chance of certain things, so that basically the first one coming back down means that there's a 75% chance it's going to bounce off of it and it's going to keep going back up, but a 25% chance it's going to go down. Once it touches the second line, utilizing 3-line strategy, the third line basically lets me know that it has a 50% chance it's going to come down and another 50% chance it's going to go up. So it's a 50-50 at that point. Once it touches the third line as it's coming down, that means it has a 75% chance it's going to keep going down and a 25% chance it may bounce off of it and keep going up. But you can see it never bounced off of it yet. It continued to stay around that second and first line, and then it did that 50% chance. It went back up. Now it's staying above the first line, and boom, it did, and then it just quickly went down through the third line. But like I said, it just kind of had a very quick response here, in and out, based off the 1 minute. Now, if we change it to the 5 minutes, you can see now it did not provide that false sell signal like the 1 minute did. So it's a lot smoother. So you may have to use one at first, but as things begin to mellow out, you may have to switch over to another one, or you can go a dual chart. Have two graphs in one. That way you can see the a 5 minute and a 1 minute. So let me see if I can pull that up here. I'll change that really quick. Line style. Okay. So we got 1 minute, we got 5 minute. Hold on here. Back there. The other one showing there. There we go. Okay. Let's do 5 there, 1 there. And that way you can always have a good comparison between the two. So we have our 1 minute over here and our 5 minute over here, and just look at the difference. The 1 minute is just a lot more busier, but more detail. and then you have your 5-minute graph over here, which is just much smoother. You do have your buying signal right here with no sell signal yet. And then we're over here, we had our buying signal right around the same buying signal as the 5-minute graph. But the 1-minute graph showed a temporary, very short-term sell signal here, but then immediately provide a buy signal and then another sell signal. So it's too many going on here. But at the same time, we're almost identifying a pattern. You can kind of see what's called a possible a bullish pennant pattern, where the price goes up and kind of zigzags and creates this little funnel thing. Now we can see it much clearer on the 5-minute chart, where we can kind of see this little, funnel thing going on, which we can kind of create a line here. So you can kind of see something going on right in here, which leads us into the next step for this meeting is patterns. Once we can identify the moving averages and the signals and stuff, it's important to also know patterns, because patterns can help provide us what the stock price may be doing next. Even though it may looking like it may getting ready to come down, but it actually may get ready to surge back up again. So it's just really important to pay very close attention to all of our signals, but we have to be aware of what those signals are. And so I'm gonna pull up a patterns chart really quick. That way that we can kind of go over that. Pull that up here. Patterns right here. So here are the most common patterns. Now, a lot of times we'll see these patterns usually on the daily graphs, or like the 1 minute, 5 minutes, things for day traders and swing traders. Now, occasionally we can find these on the daily charts, but they're not as often, where we can identify a lot of these patterns, every single day using the 1 minute and the 5 minute charts. And so some of them are bearish, some of them are bullish, and that's why it's important to know, is it trying to tell us something? Is it trying to tell us that it's getting ready to go up, or is it getting ready to go down? So the double top right here on the far left is also a very common pattern, where we may see, especially early in the morning when the stock market opens up, whether the stock market is down for the day or early in the morning or up for the morning. When the stock market opens, typically we'll see within the first 5 minutes that the stock price comes up. So 5 minutes from here to here, and it begins to hesitate. Now the next 5 minutes, the stock price begins to kind of fall down a little bit and starts hesitating and forming this neckline. Then the next 5 minutes, the stock price begins to come up, but then begins to hesitate around where the first point was of the day. And so then it begins to kind of slowly fall down, and it's like hesitating and stuff. And typically it's been about 15 minutes or slightly after 15 minutes after the stock market opens. And so when you typically see this pattern, that is definitely your double bottom pattern, letting you know that the stock price is ready to come down temporarily. Just because it comes down, it doesn't mean that it's going to stay down there. You can easily reform a new algorithm. And so, but we have these 3 key points. We have our stop, which is either our stop loss, in case if you bought in betting that the stock's going to go down with the stock options, you can easily buy a put and take advantage of this situation. And however, if the stock price or the stock market was manipulated, causing stocks to surge up or trend up, the stop is either your stop loss or it becomes an invalid strategy, letting you know to abort and to re-strategize in something else. But your moving averages will provide you that information, is if it's going to keep going down, because it'll provide you your sell signal here, which is also a buying signal to buy a put in the stock options. And so, but if you have shares, or because maybe you bought over here and just kind of waiting to see what pattern it's trying to tell you. And if you buy a put, it begins to go down, your entry level is right around where the neckline is, but you have to confirm that it is providing you that signal. So you have to wait until it passes the neckline. Once it passes that neckline, this thing's going down for quite a while. Just don't know how far or for how long, but until further notice. And so we buy the put, go down. Once it provides you that next signal, sell it, get in, get out, secure your profits, and repeat the process over and over again. And so but it's very, very important to be aware of a lot of these patterns, where, like we were just talking about the bullish pennant pattern with the with Bitcoin. And so where the stock price or crypto price comes up and begins to kind of zigzag around this area, again, it just depends on what graphs you're seeing provide you some buying and selling signals. It can be a little confusing. That's why it's important to adjust your timing for your intervals, and so that way it doesn't provide you too many signals. You just need that right one. And wait for the signal. As it gets towards the end here, it will provide you that signal, so that way you want to enter right around where this third point was, because that's basically confirming that it's getting ready to go up. And once it does, you'll see a lot of green volume, because a lot of investors and traders in Wall Street are all on the same page. They use this system. And so if every individual trader and investor can be fully aware of this, we're all synchronized at the same time. And so we can all pump this stuff up at the same time. We can all sell it at the same time. And that's what creates the volatility. We see a lot of things go up really fast, a lot of things that go down really fast, because we all use this system, and it allows us to synchronize it at the exact same time without us really communicating with each other. And so it's just really, really important to be aware of this stuff. And as well as some of these bilateral patterns. These bilateral patterns can be a 50-50, and so that can make it even more trickier, especially with the symmetrical triangle, which is very similar to the bullish pennant pattern. But the bullish pennant pattern, the price gradually went up first rather than quickly surging up, which a lot of times you'll find that happen in biopharmaceutical stocks, or maybe stocks that beat their earnings. You'll see stock prices really quickly surge up, but then they'll gap halfway down a little bit as they tend to mellow out, and then figure out what the actual value is of the stock. As it begins to get closer to the end of the funnel, it's going to pick a direction, but you have to wait until it passes one of the fourth point, or a third or fourth point. So once it passes one of these, that's the direction that it chose, and it's going to keep going that direction for quite a while until further notice. So it's just really, really important to really be aware of these. I'll post these. I always post these in our group, in our chat rooms, for our reference. But some of you guys are new here today. Some of you guys have been here. I've been attending our meetings every weekend for several months. And so, but it's just important to print this out. Make sure that you look at it daily, because out of sight, out of mind. If you're not looking at it, you're not going to retain it. And it's really important that you are aware, that you memorize everything, because you'll be like, aha, I've identified a pattern. Just by imagining like a little square box around those price lines, you'll identify that you'll see maybe the falling wedge or the bullish pennant. But it's important that you compare the angles of the lines to make sure that you've actually identified a pattern, because it could be maybe it's the descending triangle or the falling wedge. And so you just want to make sure that you really compare the angles, that way you can identify the correct pattern. There is one more pattern I'm going to pull up here that's also very, very common and very important to be aware of. Let's see here. So this is the dead bouncing cat pattern. Very important. We find this a lot, especially in like pharmaceutical stocks that have maybe been working on some kind of like a cancer treatment drug, but they've only had like a 60% success rate, and the government said no, we're not going to approve that, and then all of a sudden or maybe it was bad earnings or just bad news. whatever that it is, the stock price is affected by it and begins to swiftly move along the downtrend line, and then quickly bounces off a certain point. And whether the stock had plunged 5, 10, 50%, I've even seen stocks plunge 80%, which is incredible. But at a certain point, it bounces back up for a little bit. It could be half, it could be 50%, it could be a small percentage. You may, depending on your graph, you may get a little bit of a buy signal, but then you may get a quick sell signal. But once the price hits down where it originally bounced off of, that's where we really have to watch it, because if it continues to fall beyond that point, this stock will most likely continue to downtrend the rest of the day or the majority of the day. But if it bounces back up, then it could most likely be the double bottom pattern. So we have to be fully aware of what's going on here, because if it bounces there and then it's back up here, then most likely that's the double bottom pattern, and then it'll recover and bounce back up. But if it goes past that first bounce there, then this stock's doomed. And if you're holding shares, get out. You can always buy back in at a lower cost. But as long as you're aware of this, you can fully take advantage of the situation. You can buy puts, and as the stock goes down, your account goes up. So bad news can be great news, just depends on how you use it. So yeah, patterns, very, very important. And then I'll share this stuff with you here in just a little bit. But the next thing that's really, really important is rules. Rules are extremely important, because without them, we'd be a mess. We'd be taking in a lot of high risk situations. I'm going to pull these up here really quick. So these are the very basic, very common rules for a lot of successful investors and traders. But these rules are based off of day trading rules, but they're very similar and comparable to long term and short term and whatnot. Where the first rule is always have some kind of limitation on volume. For this example, 1 million average daily volume, as well as stock options. Make sure you have some kind of limit on some kind of volume, because you definitely don't want to get into something that has really no volume, because then there's no volatility. It's just going to be really slow, and you're just not going to gain a whole lot, but you might not lose a whole lot either. So. But have a price limit too. Even though this example is 30 cents or higher, I don't recommend anything under $1, because if it's under $1, then you're at jeopardy of that stock getting removed or delisted or penalized. Plus, the stock can go through a reverse split. It's just not worth it. So I usually recommend stocks of at least $5 or more, because they can still have a lot of potential. I've seen a lot of IPO stocks that have fallen to that point and then easily bounce back up and have gained 1,000% within a year. And so, but usually the stocks that are under $5, are going to have a much harder time trying to make it. So percentage change, that can kind of lead into moving averages as it's, trending upwards for a certain amount of time. As you're looking for percentage change, you can look at, what stocks have done in the last week, especially if it's trending upwards 5 or 10%, most likely it's going to keep going. Or especially if you're into penny stocks, you can look at pre-market activity and watch for penny stocks, and usually stocks that are over 10% may continue going over 10%. I've seen things that'll go 20, 50, 100%, 150, 200% during pre-market. But usually after pre-market, the stocks usually tend to gap down halfway as they begin to sell off and to secure their gains. And so, but penny stocks is definitely a very interesting world where you definitely want to utilize pre-market for your advantage. We got to get up super early. Number 2 is day trading only, no swing trading. The reason why it's a rule there is because day traders like to get in and out. They don't always know exactly what the next day is going to be like, but when the morning starts, they have a much better idea of what to do, because they know if the morning's bearish or bullish. They can see and wait for these buying and selling signals. They can get in, they can get out, they can secure their gains and profits without having to swing trade and hold overnight. And so that's why day traders can be very successful, is because they don't swing trade. So but there's nothing wrong with swing trading as long as you do it right. And so rule number 3, trade stocks with news, press release, etc. Anything that's causing a lot of activity. However, there's that old saying, buy on rumor, sell on news. So it's great to be aware of when the news is going to happen. That way you're holding before that happens, because when it happens, you want to be, because that when it's on the news, basically, the stock is going to be up. That's the time to sell, because all the other the professional investors are selling at that point, because they have that old saying stuck in their head: buy on rumor, sell on news. When it's on there. And then a lot of times people are like, how come there's great news, how come the stock's going down? Well, it's because of that. And so it's important that everybody stays synchronized with this information as much as possible. That way we can all react at the same time. Number 4 is volume of the day, which is high volume of the day, as well as trading stocks that have a high market cap, like Facebook or Apple and Microsoft and so on, and so, or Tesla. And so and the reason why that is because those stocks don't move like penny stocks. They don't shoot straight up 10-20% and shoot straight down 10-20%, because the moving averages and the algorithms are much harder to identify than a stock that moves 1, 2, or 5% a day. The moving averages are much smoother, and it provides a much clearer signal. So that's why it's really important to trade high market capitalization stocks. Rule number 5, enter at midpoint of support and resistance. That's basically your moving averages that we've already went over. So it's very important to pay attention to your buying and selling signals. Rule number 6, always do a limit buy and a limit sell when you're buying shares. Most stock market applications will default to a market buy and a market sell. So when you do a market buy, you're telling the system to buy any price instantly, but even if it's at a higher price than you anticipated, which is not in your favor. Now, if you do a market sell, you're telling the system to sell instantly, but to sell at any price, even if it's at a lower price than you anticipated. So that is definitely not in your favor. The only thing that it does is it does sell or buy instantly. But if you do a limit buy, you're telling the system to buy at your particular price or less, whichever is in your favor. Or if you do a limit sell, you're telling the system to sell at that particular price or higher, or whichever is in your favor. Now, the only disadvantage to this is that the order might not execute immediately, because maybe the price has passed your limit price, and because it took some time to process, to type all your settings in and send the order out. Maybe it may have taken you 5 seconds, 10 seconds, or 20 seconds to configure all that stuff and to send the order out. By that time, the price is still moving, and it's not waiting on you. So and so if it passed it, then your order might not execute until it touches it again. And you may have to go back in there. You have to modify it, or replace it, or just cancel it and start over. But a good way to try to avoid that from happening is when you do a limit buy, set the price maybe a couple pennies higher than what you normally would set your price. Or if you're doing a limit sell, sell at a couple pennies less. So that way the price is kind of adjusted, just in case if the share price has kind of passed what your price would have been. And so, but it's not like it's going to buy at that price. It's definitely going to buy it at at whatever the lower price is going to be at the time that you send the order out. Or maybe you're saying, what if the price ever reaches to a certain point, whether it be for that day, or maybe it could be weeks, or maybe months. You can say if let's say if Ford Motor Company is like around $25 a share, and you can say, oh, if it ever reaches $20 again, I want the system to automatically buy it, whether you're looking at your app or not. You can be at work or doing something. You can be asleep, and then the system is still watching out for you. And usually the settings, you can set it for towards the end of today, or for 90 days. So it can really watch for that price for the next 3 months. If it ever reaches it, it'll execute the order immediately. So you can definitely utilize these programs for your advantage. Rule number 7, ABCD pattern, enter at the C point. And so, and I usually throughout the week, I try to, remind you guys about that. And how that kind of works and stuff. Now I have another image I'll pull up here that kind of explains the ABCD pattern, enter at the C point. Give me a moment here while I pull that up. And so, but this is usually kind of a daily thing, for day traders, where when the stock market opens early in the morning, the stock price begins to come up. And so usually from here to here, it's about 15 minutes. The stock price breaks out and sets an intraday high point. So this is the first high point of the day. Now the next 15 minutes, the stock pulls back and sets an intraday low point. And that's the B point right here. And typically it's about 30 minutes between opening and at the B point. So usually within the next 30 minutes from between the B and the C, where the stock sets a higher low and begins to turn, it kind of provides a pattern as well, and so you can kind of identify what's going on there. And what we're doing is we're waiting out the volatility. That first hour and the last hour of the day is the most volatile day of the stock market. And so we're listening for the system. We're waiting for the whole, most of the risk out of the way. It provided us a pattern. It also provided us a buying signal using moving averages. We can now buy in, and then the stock breaks above the intraday high point, where the stock price begins to pass that first highest point and on up. So then we have to just kind of wait until it provides that sell signal, so we would get in and get out. So basically this whole ABCD pattern, enter at the C point, is a rule to minimize your risk. Now you can still trade within the first hour, but your risk level is much higher. You have to be more experienced and more you're just more tools under your belt. And so but to minimize your risk, it basically is saying wait after at least 1 hour. It could be 45 minutes, sometimes it could be an hour and 15 minutes, but average it's about 1 hour, and then it'll things will start providing you some signals on what to do. And so this is just part of that whole system and the rules. So we're going to switch back over the rules here. And so that was rule number 7, ABCD pattern, enter at the C point. Rule number 8 says sell 50% of your position at a target goal. Now, really, that's not a rule for day traders. Day traders get in and they get all the way out. They don't usually leave anything behind. However, I do see a lot of long-term and short-term investors will do things like this, or they'll probably buy into something and it gets to a certain point, and then they'll sell whatever dollar amount they originally put into it, and then whatever's left over they feel is like free money, and they'll just let it sit there until whenever. And so that's a very common rule for a lot of long-term and short-term investors. Rule number 9, it says beware of the false breakouts, sell right below the support level, which is something we've talked about, being aware of that using moving averages. So you really need to adjust your timing intervals, so that way you get the correct signals. Rule number 7, cut losses at a certain point, whether you're down 2%, 5% for regular stocks, or if you're into stock options, it would probably be more like 10 or 15%. maybe 20% at most, which is pretty huge. But ride winners if you're on shares, 10% or higher. If it's stock options, it'd be 20% or higher. And so these are the most common rules. Now we can always add more rules on top of that, and it can just be endless. Now every investor and trader will eventually have rules like this, but then they'll have other miscellaneous preferences and stuff. But you have to start somewhere with the basics like these. And so once you get to a certain point, it's really important to be aware of the differences between an amateur trader and a professional trader, because after we've mastered the moving averages, the patterns, we got a good set of rules. Now it's time to be the pro trader. Get the amateur trader characteristics out of your system if you have any there. So an amateur trader will let losers run and hope they turn around. There's that word hope again. I hate that, definitely dislike it, because hope, all you're doing is you're throwing money at something and hoping that it sticks. We need to be certain of things, because uncertainty is our enemy. Our professional traders will cut losers when a stop is reached and a trade idea is invalid. We know what a stop loss looks like now. We know what our buying signals and selling signals look like, what a uptrend looks like, or downtrend. So when we see certain things, we know now when to implement our stop loss, or when a trade idea becomes invalid when we're not already in there. Because like I said, there's a lot of manipulation out there. There's a lot of things that can happen. So it's just very important to be aware of that. Now, amateur traders will close winners too early because of fear of giving back profits, because they're not using a system. Maybe they're beat up, the last several weeks, and they're finally getting something good, and then they decided to sell because they weren't aware of maybe the patterns. Like I said, maybe it was providing that bullish pennant pattern. They got scared, they sold, but the system was trying to tell them that it's ready to surge back up again, and then it goes up, and then they're just kicking themselves in the butt now. And so where professional traders will let winners run until profit order, or when a clear signs are given to exit. Trust their system. The system is the moving averages and patterns, and having a good set of rules. Amateur traders change their trading system after a few losing trades, because throughout the year provides different characteristics for the stock market. We're in the first quarter, which is the winter season. So it's the bearish season of the year, so we're going to see a lot of stocks in the whole market downtrend. We'll start to see a transition in the springtime, which is April, and May and June. And so we're going to see that transition of bearish characteristics turning into bullish characteristics. And then we have July, August, and September. That is the summertime. It's the third quarter. That is the bullish season of the year. And so a lot of times a lot of new traders at that time will think that whatever that they're doing is working, and they're going to stick with it. And then as we get into the fall and the winter time, it doesn't work out. They've just lost all the gains that they have made for the summertime. And that's why it's important to have a system, because the system works throughout any scenario, throughout the entire year, or whether we're in a recession or whatever. It's important to implement these rules, because it never changes. And so where a professional trader will stick to these rules religiously and think process oriented, keep the emotions out, think, like I said, process oriented, think statistically, analytically, but also strategically. Amateur traders close their trades, never look at them, and avoid a learning effect. A lot of times you'll see that they'll post online, hey, I got $3,000, what should I put it on? Because they're unable to really learn, which is unfortunate. And so where professional traders analyze past performance, keep a trading journal, and learn from their past behaviors, but also from others as well. Just like one of the reasons why you're here, we need to learn from each other. because the more you learn, the more you're going to earn. But you also want to learn not only from your mistakes, but also from other people's mistakes. That way you don't make them. And so the goal is to really try to be highly effective as quickly and as much as possible. So an amateur trader sometimes will overtrade and revenge trade and hope to make a lot of money fast. Now, there's nothing wrong with making a lot of money fast as long as you do it the right way. But if you do a revenge trade, then your emotions have the best of you. They're taking over, and that's when you're going to start making a lot of mistakes, especially when you have hope involved, because now you're hoping your revenge trade or hoping by throwing money at something that it's going to stick. And so that's not how you do it. That's not how you day trade and swing trade and invest. Where professional traders are aware of their emotional impacts and know how to identify and manage their impulsive buying and selling decisions. That's one of the huge thing is to never use emotion, never buy or sell based on emotion. It's the same thing when you're buying a car or a house, as well as stocks. So keep the emotions out. Think process oriented. Think statistically, analytically, and strategically. Amateur traders open their trading platform and then desperately try to find random trade entries, which is, it's nothing wrong with finding random trade entries as long as we do it the right way. But you definitely don't want to just go on social media and try and ask people, because a lot of times you'll get people that are going to tell you to buy stocks that they're holding, so that way you can try to pump them up. So we want to try to find random trade entries based off of statistics and analytics. But also, one of the key rules is, one of the old sayings goes, always follow the money. So we need to try to find things that are flying under the radar. Where professional traders will keep a trading plan and plan their trading day ahead, follow a structured approach. And that leads us to the next thing, is that structured approach, is being able to plan ahead and how to do that. There's always a lot of stuff that's scheduled to happen. And I remember being new in the stock market many years ago. I never knew how much affects the stock market. And whether it be the news and this and that, and so you just always had to follow the source. And so again, the more you learn, the more that you earn. And so I just did that every day. There was always something more to learn. And I found out that one of the biggest things that have a huge effect on the stock market was economic reports. And so when I had learned that, I was trying to find ways to pull more information on that. It took me a little while, but I figured it out. And so there's a website. I'm going to flip screens here really quick. That's called investing.com. Now, they do have an application as well for your tablet as well as your mobile phone. But using the website, right now we want to use the economic calendar. Now there's also earning calendars. Now, if you're using the mobile phone or the mobile application, it's on the bottom. It should look like a calendar. If you click on that, then you'll need to change on the top menu part from whatever it is. If it's on earnings calendar, change it to economic calendar. Once we're in that area, we need to click on filters, because we need this website and system to pull up some specific information. So if I click on filters, or if you're on the mobile application, it looks like a little funnel. Once we're there, we want to click on clear, because we want to clear everything. There's only two things that we need to see. The first thing is the United States, and then under importance, we have a 1-star, 2 stars, and a 3 stars. We want to put a check mark under 3 stars because we're requesting everything that'll have the biggest impact on the United States stock market system. So then click apply. Now, if we're looking at it on the website, it's going to provide us the time based on Eastern time, where the stock market is in New York. But if you're looking at it on your mobile phone or your tablet, it's going to provide you the time of these reports based on your time zone. So it's very important that you are aware of that, as well as what time the stock market opens and what time it closes in your time zone. Because the stock market can easily be affected before the report, during the report, and after the report. So it's extremely crucial that you are aware of all this stuff. So for this week, as we click this week, we have all the most important economic reports that have the biggest impact on the United States stock market. The only thing that has more power than this would be probably big international issues, like if countries started doing lockdowns or whatever, nobody in or out, that can have effect. Kim Jong-un, launching a missile, I mean, even though he does that a lot, but if it's something that's unusual that they haven't done before, or maybe a war, whatever, an invasion, I mean, there's all kinds of things that can happen. Especially with the news kind of giving clues that China can take over Taiwan, Russia can take over Ukraine. That can cause a huge, massive drop in the entire stock market system that will outweigh this. But for the majority, the economic reports outbeat pretty much everything else. And so so not seeing anything scheduled for Monday, then typically that's normal. We don't normally see economic reports on a Monday or a Friday, but we do see some on this Friday, which is great for the volatility that we're looking for. But Monday there's nothing. So but Monday is usually can be still volatile because coming back from the weekend, you have a lot of people that have holding from the weekend that are going to sell. You have a lot of people that are ready to buy that maybe weren't holding throughout the weekend that'll start buying on Monday, and so we can see a lot of volatility on Monday, and usually it's pretty bullish because we'll see more buying activity than selling activity. And so Monday is just kind of a getting started day. And so, but it can reflect any kind of news throughout the weekend. I haven't really seen any major bad news or good news. And so, I think things may be kind of on a cruise, like a cruise control kind of thing for Monday. But Tuesday, so 10 o'clock. So in Eastern time zone, the stock market opens at 9:30 in the morning. So looking at this obviously the federal speaker Jerome Powell is going to speak at 30 minutes after the stock market opens, and so he usually has a pretty big influence in the stock market. And so, but normally he has a bullish influence in the stock market. Maybe a little volatile at first. We could see a little dip before or maybe during, but after he starts talking, typically it's bullish. So we'll just kind of have to wait and see, how the market reacts. But I think the pre-market will provide us a good clue whether it's going to be good or bad. Because we're in a new year, and so there's a lot of changes, there's a lot of things that the politicians want to start doing. They want to start talking about inflation. We'll start talking about increasing interest rates and stuff. We saw how that went last week. It did not go very well, and because they're taking action now versus last year when they were just talking about it. This year they're talking about it and taking action as they talk. And so, and that's the difference. And so at noon, it looks like they're going to talk about the energy outlook. So, and this is all just talk. There's no previous reports or forecasts and stuff like we'll see on Wednesday. So it looks like there's just a lot of government, a lot of government meetings, a lot of government politicians talking and whatnot on Tuesday. So that's gonna provide a lot of volatility. Just from that. So it's just really hard to determine that because we just don't have a lot of a lot of data on that. So proceed with caution. It might be best to probably straddle, buy both calls and puts for Tuesday. Wednesday. So we have at 8:30, we have the core CPI for month over month of December that is scheduled to be reported 1 hour before the stock market opens. So that provides us a lot of pre-market volatility, great volatility that we're looking for, especially if we're holding stock options. And so, but the previous report for the month of November was reported at 0.5%, and it's anticipated to be the same at 0.5%. And if you're not sure exactly what these are yet, you can feel free to click on them. A new tab will appear, or on your mobile phone, the next page will load, and it'll tell you exactly what it is and how it'll affect the stock market. So the CPI basically is your core consumer price index that measures the changes in the price of goods and services, excluding food and energy. The CPI measures price from the change from the perspective of the consumer. It is a key way to measure changes in purchasing trends and inflation. A higher than expected reading should be taken as a positive or bullish for the US dollar or the stock market, while a lower than expected reading should be taken as a negative or bearish for the US dollar or the stock market. And so, but there are weekly reports, there are monthly reports, there are quarterly reports, and there are yearly reports. The more rare the report is, the more of an impact it'll have on the stock market. So if it's a yearly report, which those are coming up soon, will have a huge impact on the stock market. If it's a quarterly report, which those are coming as well, those will have a big impact on the stock market. If it's a weekly or a monthly report, it'll have a very decent impact on the stock market. But if it's a weekly or a report like crude oil inventories, unemployment, those have a pretty good, impact on the stock market, but just not as much as if it was a monthly, quarterly, or a yearly economic report, which is one of the reasons why the first quarter becomes so bearish, is because of the yearly economic reports that are soon to come. Usually things are mentioned that investors in Wall Street don't want to hear. And so they begin to start selling off and whatnot until after those yearly economic reports are done, which is usually towards the middle of March. Then we're looking at a much brighter, bullish, characteristics ahead as we begin to enter the spring season. So, it's amazing how well these have an effect on the stock market. But after a while, when you start looking at these regularly, hopefully every day, you'll memorize them. You'll know exactly what these are and how they'll affect things, and whether the numbers need to be up or down, because there's other things like your crude oil inventories or your unemployment report, which is your initial jobless claims. These numbers need to be down. The lower the numbers, the better. But versus other economic reports, we need those numbers up. The higher, the better. So it's very important that you are aware of these and know how it can affect the stock market. So the crude oil inventories, it will be reported next after your core CPI on Wednesday. But this report is scheduled to be reported at 10:30 Eastern time, which is 1 hour after the stock market opens. So we have something that's going to affect the stock market during pre-market, and then we have another economic report that is going to affect the stock market after the stock market opens. So it's kind of continuing the momentum of things. And so, but the crude oil inventories, the previous report was down negative 2.14 million barrels. And so there's no forecast yet. So, and that's why it's important that we need to, keep checking this regularly, because they'll put a forecast in here probably later tonight or tomorrow, as well as they may throw in an unexpected economic report, or maybe a speaker will talk or something. And so that's really important that we look at this every weekend as well as every day, because things can change. And we need to see what the forecast amounts are that aren't there, as well as the actual results, because it will provide us information whether the day is going to be bullish or bearish, or maybe sometimes one report could be good and the other report will be bad. Then that lets us know the day is going to provide us mixed signals. The day could be flat, or maybe there's certain segments of the stock market that'll be up and certain segments that'll be down. And sometimes they'll put the forecast amount pretty low, like they'll set the bar low, like intentionally making it so that way it's going to beat it, providing, manipulating the stock market system, like intentionally. I don't know exactly where they get these forecast amounts. They just pull them out of thin air or whatever, but sometimes I've seen them pretty high, sometimes I've seen them pretty low, like I said, like they're doing it intentionally, creating that volatility or a bearish characteristics for that day or bullish characteristics for the day, like pouring fuel on the fire. Like they know what these days are going to be like, but they're just pouring fuel on the fire. And so, but we'll have to see what the forecast is going to be, because this is a weekly report. So this was for last week. So not a lot of driving. I would say for last week there was a huge snowstorm. I think from coast to coast. So I would anticipate, in fact, that the crude oil inventory levels are going to be up, which is going to be bearish. So that's not going to be good. And with this report being kind of the same, I don't think Wednesday, I don't know. It just, that's kind of a weird, I don't think this is going to be a good day. I would say Wednesday is going to be bearish. Look at analyzing this, so even if the CPI month over month ends up doing pretty good, it will provide maybe a very small time frame of bullish characteristics, but after 2 hours of that, when this crude oil inventory report gets reported, it's not going to be good. This bullish characteristics is going to turn into bearish characteristics, and it could probably last all day. And so we'll really have to wait and see what happens, but it just doesn't look good, at least towards the end of Wednesday. I'd say altogether Wednesday just doesn't look good. Looks bearish. So Thursday we have the unemployment report. This is a weekly report. Looks like both of these reports for Thursday look like they're going to be released 1 hour before the stock market opens. So this is going to provide a lot of volatility during pre-market, which is what we want, especially for doing trading stock options. And so the unemployment report last week was reported up, where the week before that was like 195 or something. And so it was up, it bounced to 207. I have a feeling it could bounce back down, but then again, a lot of those seasonal jobs are probably done and over with. So there's a possibility it could keep going up too, especially with the winter storm that we have. I don't know how that can affect or how that may affect people's jobs and whatnot, but we have to really proceed with caution, because we're really kind of in this middle of the transition from the holiday season. And so but typically when it goes up like that, it bounces back down, or if it goes down, it bounces and goes back up. So or it could just kind of range around that 200,000 for a little while. We'll have to kind of wait and see. And then we have the PPI month over month. Again, if you're not sure what those are, you can always click on them, and it tells you right there. So the PPI is your producer price index that measures the change in the price of goods sold by the manufacturers. It is a leading indicator of the consumer price inflation, which accounts for the majority of the overall inflation. A higher than expected reading should be taken as a positive or bullish for the US dollar or the stock market, while a lower than expected reading should be taken as a negative or bearish for the US dollar or the stock market. So, however, inflation has been great for the economy and the stock market, not so much for us buying things at the store, but it becomes more profitable for the manufacturers. If the manufacturers are more profitable, they will be able to beat their earnings and revenue and whatnot. And so, but if the government and banks begin to start increasing interest rates between now and the next 2 years, it'll start to cause the inflation to come down. So then these companies might not be as profitable, or and so that we may see a little struggle a little bit here for the next few years. But it just depends on what these companies decide to do. These tech companies primarily, and that way they can maintain their revenue. So, but we're entering the season of the banks, because as the banks begin to increase their interest rates, they'll become more profitable. So we'll start seeing a lot of activity on a lot of banks, and like Chase or JP Morgan Chase and Bank of America and all kinds of banks. And so because it's their time, and every year different segments do very well. And so the PPI month over month for December, again, this is a monthly report, so it will have a lot more influence on the stock market that day than probably the unemployment report, which is a weekly report. So the previous report was up to 0.8%, and now they're thinking that things are slowing down to 0.8% up. So like I said, we're kind of at the top of the inflation and now. So but once the interest rates start coming up, which the government will start setting deadlines for that, these numbers will then be in the negatives. And so this may be the last month for this inflation to be in the positive. And so hopefully this will maintain a bullish characteristics for Thursday. So we have Wednesday. So Tuesday, just not exactly sure what's going on there. My guess is, even though in the past Jerome Powell has provided good bullish characteristics, they may say something that may spook investors and traders. So Monday could be a bullish day, Tuesday could be a bearish day, Wednesday could be a bullish day, Thursday could be a bearish day. And then so you can kind of see this algorithm. We have up, down, and then Friday we have 8:30. We have two 8:30s, so 1 hour before the stock market opens. And so again, this is going to have a big impact on the stock market during pre-market, which will be great for our stock options. So the first one will be the core retail sales for the month over month for the month of December. So the previous month for November was 0.3%. So they're thinking it's going to be at 0.2%. And so where the regular retail sales will be down a little bit. So this is obviously affected by shortages. If retail stores have a short supply of things, they're not able to sell. If people aren't able to travel, if there's a lot of severe weather, they can't travel and they can't buy things, and truck drivers can't deliver things. And so, it's going to be interesting to see how these reports, but then again, these forecast numbers could be too low intentionally, because December is a great, phenomenal retail month. It's just bizarre that these numbers are this low. They should be at this high, if not higher. So I feel that these numbers are placed in here intentionally low, basically pouring fuel in the fire, because as long as they can meet or beat these, we're good. If they can meet or beat the previous report, we're even better. So to me, it just feels like it's intentionally meant to beat whatever the forecast is, creating bullish characteristics for this day. Just don't know for how long. It could go towards the end of the day. But there are a group of investors that don't like to hold throughout the weekends. They'll sell, and that can create a little sell-off, or maybe a little dip, right before close. So Monday looks, like I said, looks like it's up. We got down, and then up. To me, that's what it looks like. That's what I'm going to stick with. That's our plan for this week. And so, and then the next thing that has a pretty big impact on not so much the entire stock market, but it could have a pretty big impact on segments of the stock market, and that's the earnings report. So I always post in our stock market group under our featured area or announcements this next scheduled week's highly anticipated earnings reports. So as long as you click the featured area, you'll find that here. And I post this every Saturday consistently since I created our stock market group many years ago. And so we can always click on the image. You'll see a great schedule here for Monday, Tuesday, Wednesday, and Thursday, and Friday. Now we've just entered in a new earnings season, so it's just barely starting. And so, but there's a few good companies in here, but there'll be more, next week. But the top 10 will be in the description. So Tilray being number 1, and then JP Morgan for second, and then Citigroup. We have Delta Airlines, Wells Fargo, Commercial Metals, Taiwan Semiconductor, BlackRock, AZZ, and KB Home. Now, I'll post a lot of this stuff, the analytics or the analysis in here, so that way we can kind of look over some of the the details. But I'll kind of highlight certain things. But also, I will post within the picture some clues about the company. So KB Home, just by looking at that, we wouldn't really know what that company is. But by looking at the picture, we've now confirmed this is a company that sells homes. Now, again, these earnings reports are for the fourth quarter for the next 3 months. And so if we're looking at a company that sells homes for the fourth quarter, it's basically, I don't know if you know anybody that's in the realty or home buying and selling business, but, the fourth quarter is usually very, very huge. Because, and not only that, but the housing industry for the last 2 years has been phenomenal. And because, for many reasons, people are relocating out of the city, maybe going into small countrysides because maybe they're working from home or whatever. And but ultimately, people like to buy houses before the holidays, before Thanksgiving, before Christmas. They like to be in their new house by that time. That way they can have everything set up. After that, then the housing market, dies out a little bit. And so KB Home, basically this company's earnings release has a 78% expecting an earnings beat. Out of every single earnings report this week, this holds the highest percentage chance than any other earnings report this week. Typically, an average percentage is about 65%. If it's any higher than that, you can kind of consider that above average. If it's any less than that, you can kind of consider that a below average. 78%, you're almost at 80%, which is almost unheard of. If you translate that into odds, you basically have 4 out of 5 chances that this stock is going to beat their earnings and the stock's going to go up. And so there's just many ways you can analyze this information and utilize it for your advantage. And that's why it's really important to look at this stuff every week that I post under our features area. Now, if we'll scroll up here, let's see, the next one is AZZ. AZZ is scheduled to release their earnings report on Monday morning. So it's tomorrow morning before the stock market opens. They have a 47% chance or expecting an earnings beat. Out of every stock this week for their earnings, AZZ holds the lowest percentage chance of beating their earnings next to Tilray. Tilray is like 50%. And so that is not good. And so, and these are basically going to hit the news. And so if these don't do well and they miss their earnings and revenue, these stocks could plunge for quite a while. But we could take advantage of that. If we see what's going on, and if we're into stock options, we can buy a put and take advantage of that, ride that wave down, and have our account go up, and secure our profits and take advantage of the situation. So so BlackRock is next in line here. They are scheduled to release their earnings report on Friday after or before the stock market opens. They have a 67% expecting an earnings beat. So the next one up is the Tilray Semiconductor manufacturer. So again, holding a little picture here with the microchip, letting you know that this is huge. What's one of the biggest things that we have a shortage in right now is microchips. And if there's a shortage in microchips, there's going to be a shortage in computers, electronics, automobiles, all kinds of stuff. And so the Taiwan Semiconductor manufacturer is one of the major manufacturers in the world that makes the most microchips than any other company. And so, but it also makes it more of a desirable country, and that's one of the reasons why China really wants to invade that country. Is because of that. But also, these guys are working around the clock to meet the demand, which is so high, and still they can't meet demand. And so, but they're scheduled to report their earnings release on Thursday morning before the stock market opens. And the company has the company's earnings release has a 69% expecting an earnings beat, so just a little bit above average. And so now we have CMC, which is the commercial metals company. They are scheduled to release their earnings report tomorrow morning before the stock market opens. The company earnings release has a 63% expecting an earnings beat, which is not good. So looking at the image, we can kind of see that they're obviously a metals manufacturer, which is also part of the shortage in rare earth materials, and that's one of the things that key ingredients for microchips is rare earth materials. If they can't get rare earth materials, they can't build microchips. And if we can't get rare earth materials, we can't manufacture metals or steels and irons and aluminum and all kinds of stuff. And so, but I'm sure they're probably also faced with a shortage in staff. They probably had issues with coronavirus outbreaks and all kinds of stuff. And so, usually you would think that this percentage would be a little higher than average, especially with this time. But it seems to be right around average at 63% expecting an earnings beat. Now, Wells Fargo, we're just kind of entering the bank season. It hasn't quite started yet, but it is really right around the corner. So Wells Fargo is scheduled to release their earnings report on Friday morning before the stock market opens. The company's earnings release has a 56% expecting an earnings beat, which is not good, but maybe that's what we're looking for. Hopefully they don't beat their earnings and they kind of plunge down, because now we can buy at the dip, which would be a great buying opportunity right before the bank season begins. So great strategy right there. Delta Airlines is scheduled to release their earnings report on Thursday morning before the stock market opens. The company's earnings release has a 58% expecting an earnings beat, which is below average. That's not a good number, as a lot of countries or a few countries throughout the fourth quarter did travel bans, and there was limitations, there was delays due to weather, there was cancellations. What a nightmare. So not good for their earnings report. Next one is Citibank. So Citibank, or Citigroup, is scheduled to release their earnings report Friday morning before the stock market opens. The company earnings release has a 67% expecting an earnings beat, which is right around average. It's not bad. Next one is JP Morgan Chase. is scheduled to release their earnings report Friday morning before the stock market opens. Company release, or the company's earnings release, has a 66% expecting an earnings beat, which is just around average. Here's Tilray, last but not least. Tilray, which a lot of people are going to be talking about it. They may be trying to pump it up or whatever, but it's not looking good for Tilray. The cannabis market is flooded in Canada, and it's flooded here as well for states that legalize recreational cannabis. And so it's really hard for these farmers to make money. They have to grow a lot. They have to sell on volume to make any kind of money. And so the stores are the places that are making all the money. And so and if it ever legalizes here in the United States, we'll see some massive surges in these. But once it legalizes in the United States, it'll plunge because the market will flood. Plus, we'll see other like corporations that'll buy each other out and stuff. And it's going to be a different world when that happens. But just know, once the U.S. starts talking about it, giving deadlines that they're going to legalize cannabis, which should be pretty soon. I would anticipate it should be within a year or two or a couple of years. Once the United States gets so many states that have legalized recreational cannabis, it's an automatic time to legalize it from coast to coast, rather than voting for it. It'll just happen automatically. And so, but for Tilray, it is confirmed to release their earnings report tomorrow morning before the stock market opens. The company's earning release has a 51% expecting an earnings beat, which is not good. 50-50. Plus, with just knowing the that industry and its algorithms and stuff, I would anticipate that their stocks they're going to plunge, good, 5, 10, 15% or so. This one says option traders are pricing in a 15% move on earnings, and the stock has a 13.3% move in recent quarters. So I would think 10-15% down once this is released. So not good for Tilray, which is unfortunate. So the other key thing is really, once you have the application downloaded on your mobile phone for investing.com, that's one of a really vital news alerts that it does provide you. And one of them, every Sunday morning, they provide the top 5 things to watch in the markets in the week ahead. And so when we click on it, one of the things that we want to do after we've done our due diligence, we're planning ahead, is to try to find anything that we may have missed. Because a lot of the stuff in here, it'll talk about a lot of the things that we've already talked about. So for example, the coming week will bring closely followed inflation figures, while the Federal Reserve Chair Jerome Powell and Vice Chair are to testify at their nomination hearing on Tuesday and Thursday. So we knew about the Tuesday, didn't know about the Thursday. So respectively, it also marks the start of the fourth quarter earnings season, with several large banks reporting on Friday. Volatility looks set to remain elevated in equities markets after a choppy start to 2022, and Bitcoin remains under pressure. Here's what we need to know to start our week. So number one, the most important thing was the inflation data. Wednesday's consumer price inflation data is expected to show headlines where the CPI breaking above 7% year on year, rapidly approaching a 4-decade high, with the core rate rising well above 5% year over year. Producer price inflation data the following day is also expected to show a surge higher, which is good. That's what we want to keep the momentum going. Once they start providing this inflation data starting to go down, then that's when the stock market is going to start going down, because then the interest rates are starting to go up, and so that's where we're going to start to see a transition from people are going to start selling their tech stocks and buying bank stocks. And so the inflation numbers will likely underscore why the Fed could start its rate hike cycle as early as March. So adding the argument for faster tightening is Friday's job report, which indicated that the labor market is at or near maximum employment. While job growth overwhelmed in December, the unemployment rate tumbled to a 22-month low and wages increased solidly. Says the inflation data will be followed by reports on December retail sales and industrial production on Friday. So number 2, the Powell testimony, where the Jerome Powell is due to testify Tuesday before the Senate Banking Committee at a hearing to confirm his nomination to a second 4-year term as Fed head, while Fed governor is to appeal before the same committee 2 days later for a confirmation hearing on her nomination to vice chair. So that must be on Thursday. Several Fed officials are also due to make appearances during the week, including other people. I have no idea who those are, but will have an impact on the stock market, so it's good to be aware. But these two, though, are the big ones. Jerome Powell is number 1. Their comments will be closely watched in the wake of the last week's Fed minutes, which indicated that a very tight job market and elevated inflation might require officials to raise interest rates sooner than expected. Number 3, earnings. Earnings season kicked off in earnest in the coming weeks, with investors getting a look at a fourth quarter results from several large banks, including JP Morgan, Citigroup, and Wells Fargo ahead of the market open on Friday. So massive profit increases from the United States companies helped fuel a 27% gain in the S&P 500 in 2021. But companies will likely have a difficult time posting similar numbers for the fourth quarter. Earnings for the S&P 500 companies are expected to jump 22.3%, according to the whatever that is, data recited by Reuters. A solid increase, but still a slower pace than was seen in the first, second, and third quarters. Investors will be eager to hear about the inflation, whether companies believe the supply chain crunch that helped drive prices up last year will ease in coming months, and forecast for 2022. So that's going to create a lot of volatility this week. So number 4, volatility to continue. As we were just talking, inflation's that Fed is ready to hike rates faster than previously anticipated as it combats surging inflation rolled markets in the first week of 2022, and that volatility looks set to continue. So one of the things when they keep talking about rate hikes faster than previously anticipated, they were anticipating doing 2 rate hikes per year for the next 2 years. So that means that there would have been an interest rate hike in June, and then another one in December. But they decided to do it 3 rate hikes per year for the next 2 years. So it looks like it would be basically 3 a year. So you're thinking probably March, April would be the first rate hike, and then the next one would be around August or so, and then the next one would be like December. And so so that's it's going to happen a lot sooner than what they expected. So last week we saw that the Dow fell about 0.3%, where the S&P declined 1.9% and the Nasdaq dropped 4.5%, which is quite a bit. While the U.S. benchmark 5-year yield soared to a 2-year high on Friday on the outlook for the Fed rate hikes. The sentiment has turned negative, this Jake Dollarhide said, Chief Executive Officer of the Longbow Asset Management in Tulsa, Oklahoma, told Reuters. Right now, the market is nervous and in the mood to sell at the first hint of bad news. So, could easily create, if it hasn't already, created a what's called a triggered what's the word I'm looking for? A correction. And so So we'll just to be determined on that. Investors have been rotating out of technology heavy growth shares and into more value oriented shares, which they think may do better in high interest rate environments. Rising cases of the Omicron variant of coronavirus also contributed to the risk or the risk off mood in markets. And then number 5, Bitcoin has come under a lot of pressure lately since the start of the new year, falling to its lowest level since late September, amid a broader sell-off in cryptocurrencies driven by concerns over the prospect of a more hawkish Fed. The world's largest cryptocurrency market value has fallen over 40% since hitting an all-time high of $69,000 in November, driven lower by expectations that the United States Central Bank will hike interest rates sooner than expected. More aggressive policy action by Fed would sap investor appetite for riskier assets. Now, this whole cryptocurrency algorithm, this is typical. Now, the dip. Now, usually cryptocurrency does pretty well during the winter time. Then during the summertime, usually is when we'll see the dip. But what I'm starting to see is that we're starting to see kind of the stock market and the cryptocurrency algorithms are kind of mirroring its kind of its algorithm a little bit with the system. So it's very interesting to see that when they used to be kind of opposite. But it's still typical to see this happen with Bitcoin and cryptocurrency, because where stocks usually have a yearly algorithm and a 10-year algorithm, cryptocurrency normally has a 4-year algorithm, because Bitcoin has what's called a Bitcoin halving event. Now, the last Bitcoin halving event took place in May of 2020. So the next Bitcoin halving event will take place in May of 2024. So if you don't know what Bitcoin halving is, it's an event where they subtract Bitcoin out of the system. So if there's less in anything, there becomes a short supply, high demand. It becomes more valuable. So every 4 years, they subtract Bitcoin out of the system, and it creates a massive surge, because if there's less in the system, it becomes more valuable. It becomes more, and it goes up. So before the last Bitcoin halving event took place, the record highs, the all-time high was like $16,000, $17,000, and then it went down to as low as $3,000. But it stayed around $10,000. So it fluctuated between that $16,000, $17,000 range and $3,000 range, but it always kind of met around that $10,000, met in the middle right there. And so now $69,000 is the all-time high. And now it's fluctuating, it's finding its bottom again, wherever that's going to be. And it could be that, of where it's at, $40,000 range is I think where it's at now. And so but once the Bitcoin halving event takes place again, we're going to see some pretty crazy all-time highs again. We could easily see it reach $200,000. It's inevitable Bitcoin will reach $1 million. It's not a matter of if, but when. In my anticipation, with my due diligence and my prediction, I would predict Bitcoin could reach $1 million between 15 and 17 years. It's like I said, it's not a matter of if, but when. It will happen. It's an inevitable. It will happen. So we are seeking a broad risk-off sentiment across all markets currently, as inflationary concerns and rate hikes appear to be at the forefront of speculators' minds. And so liquidity of the Bitcoin has been quite thin on both sides, and there's a risk of retreat back to the mid-30s on the short term, which I would not be surprised if it did reach $30,000, as we had looked at Bitcoin a little bit, or we talked about it more in the past. Bitcoin was also pressured lower as global computing power of its network dropped sharply last week, followed by the shutdown of Kazakhstan's internet during an uprising, which hit a rapidly growth cryptocurrency mining industry. It was very interesting that how cryptocurrency can really be affected by international issues. And so, but again, bad news can be great news. Just depends on how we utilize this information. So a lot of stuff that's getting ready to happen for this week. So it's really fascinating to know, what days are going to be, what bearish, bullish. So now we have a great idea of what's going to happen. So it's also important to be aware of activity. And so I specialize in a lot of things, but prefer stock options. So whether you're into stock options or not, it's still very important to be aware of what the activity is providing. And so I use a website called barchart.com for a lot of this options information. So if you click on the options menu, first thing you want to pull up is most active options, because whether you're into it or not, like I said, this is still highly valuable information, because with options, well, part of remember the rule that we talked about is follow the money. That's an old saying that pro traders have been saying for a long time. Follow the money. And so the options activity provides a lot of that highly valuable information. So when this page here provides us the overall activity for stock options out of the entire system. Now this is for Friday, right before or right at close. So Apple was and is always the most active stock option because people like to day trade it. Apple doesn't move very much. It usually moves around 1%, maybe 2% or 3% at most. It's very predictable, especially with its algorithms, and it makes a lot. You can gain a lot, or you can also lose a lot. Every 1% Apple moves is like a 50% gain or loss in the options world. And so a lot of people will just day trade that, not pay attention to anything else. Why fix something that's not broken? Why look for things if you're being successful with just one stock? That's fine. Whatever works. And so by looking at some of this information, we can see the ticker name there, the company names here. We can see the share price is right there, the activity for that day, whether the stock is up or down. We see the options total volume out of all the calls and puts that put together. Now we have the overall put percentage ratio on as well as the call percentage ratio. Out of this options volume, almost 60% are betting the stock is going to go up, where 40% are betting against the stock, betting the stock is going to go down. So rather than listening to people, especially on social media, getting their ideas, do you think the stock's going to go up or down? Follow the money, see where they're investing the money and where they're putting this money at. Are they betting the stock's going to go down or betting it's going to go up? So just like the earnings reports, the analysis that we were talking about earlier on our Facebook group, where 65% is normally the average. It's the same thing here. 65% is about average for your call percentage ratio. So being at 60% is just slightly below average. But look at this. We see the Bank of America at 80, almost 81%. That is way beyond average. And so, and plus, when we're looking at this regularly on a daily basis, we can identify what stocks are normally on here and what stocks are not normally on here. And we usually see stocks that are normally on here is because day traders like day trading those stocks, because they provide a smooth algorithm. They're easy to predict. They provide a good volatility, good profits and stuff. Plus, maybe a lot of people will straddle these. Plus, they may not have a lot of time depreciation or time decay. But even if you're not into stock options, you can still buy these as shares. So if a lot of people are betting that Bank of America is going to go up and to continue to go up for not just maybe for one day, maybe for a week or weeks or months, you know, we can kind of do some more due diligence in that. We can buy them as shares and ride the wave. You know, maybe we need to look at the moving averages. You know, so now we can go to let's go to the Weeble or whatever graph that you use for your charts. And we put in, you know, Bank of America. Let's see where it is on the graph. And so we do see that it has, you know, did provide a buy signal quite a while ago down here, and it's trending up. But normally when you see a stock go up like this, it's just started, or maybe it's right in the middle. Normally when it goes up, there's at least like 3 spikes or 4. Or if it goes down, there's usually 3 or 4 spikes, little points. And so it looks like to me it's right in the middle. So the best time to get back in when we've kind of, what's the word I'm looking for? When we miss the opportunity, because like I said, the MACD provided us a buy signal here. It's letting us know, hey, I'm getting ready to go up. Hey, are you listening? I'm ready to go up. And then boom, were you listening? And then so, okay, we missed the opportunity. When should we get back in? Is when it comes down and touches the moving average lines. That's when we get in, because when it bounces down the first line, when it's already going up, that means that there's a 75% chance it's going to keep going up, and a 25% chance it's going to go down. But if it does touch the second line, that's 50-50. If it touches the third line, that means there's a 75% chance it's going to go down, but a 25% chance it'll bounce up. But with this kind of momentum and that amount of buying activity, most likely this thing will bounce there and it'll just keep bouncing and going up. And so, but that is the activity that we're kind of seeing. So we are seeing a pretty fresh uptrend for the bank, but we're starting to see a lot of downtrending for tech stocks. And so, but like I said, we just got to put all the pieces of the puzzle together to make it a much clearer and more intelligent buying and selling decision. Let's switch back over here. So Bank of America. So let's say we identified that of highly unusual activity because we're at 80% call ratio. It's on the list when it's not normally on the list. It's green. And so we need more information. So there's a website that's through NASDAQ that I use. We'll type in Bank of America in the ticker code. Hopefully I can get that to load. For some reason the website, let me close in here. It's acting weird. Go there, okay. So with utilizing the NASDAQ website, I use this to provide me the most active individual calls and puts for the particular stock option. So in this case, Bank of America. So that way we can see what are people doing. Follow the money, remember, follow the money. The volume is where people are putting the money at. So we have out of everything here, we have a $50 call strike price that is up for that day, 68% just in one day. And so we had an open interest of 103,000, which is a lot. That's a lot of interest. And then the volume is 68,000. So, and if you're not sure what open interest is, maybe it's new for you because, you know, this is, you know, options and whatnot. And you don't see that in regular shares because all you see is volume. Volume is today's buying and selling activity. Open interest is kind of like an accumulation of volume prior from today. So it accumulates. So Monday we'll see this open interest grow because this volume will then merge itself into the open interest. So it accumulates until that particular option expires, and then the volume will reset back to 0 and then it accumulate for that day. But it's providing us, like I said, a lot of good, valuable information and activity because we're seeing more and more interest on the $50 call strike price. And we're seeing more activity on other strike prices like the $49 strike price that only had a open interest of just under a 12,000. And now we have the volume amount of 59,000. what that's telling us is that at first, let's say Thursday, it had no interest or very little interest on the $49 call strike price. But now all of a sudden, we see a pure, massive, unusual buying activity of this $49 call strike price, which again, it's currently at $49. If you're doing stock options, I usually recommend buying either right at the money or maybe in the money, because if you start buying out of the money, the time decay and the depreciation is more in effect than it would be if you were if you're right on the money or in the money. And so, but when we're looking at this on NASDAQ's website, it's still important that we click on it because before they did the redesign, they used to put the expiration date right in each row, but now you have to click on it to see what the expiration date is. So it's very, very important when you're looking at this stuff during either on a Friday, Saturday, or Sunday, that you are aware whether the stock option is about to expire or if it's already expired. So like, for example, we'll take a look at this $49 one, see if that one's expired or not. So January 7th, so that is expired. So it is no longer valid with our due diligence. So again, that's why it's really important to be aware as we're looking at options, whether it's expired or not. That way we can always move forward with things that are not expired. So, but the put still has some activity here, but it looks like this one's down 99%. So, and you can see the last price, which is the current value of that individual call or put. And so obviously these are expired and expired worthless. So I'd say there's really not a lot of activity for the puts. And that's why we're seeing an 81% call ratio over a 19% put ratio. And that's how we do part of this due diligence. We just got to put all the pieces of the puzzle together to make a much clearer and intelligent buying and selling decision. So, but we just work our way down the list. You start from the top, work your way down. We got Ford Motor Company, which is usually either on the bottom of the list or the middle of the list. But lately, in this last week, there's been a lot of news with the automotive industry. We had Chevrolet. I think they revealed their all-electric Silverado. Dodge Ram is getting ready to reveal their Ram 1500 all-electric pickup truck. Now the Ford F-150 is going to be the least expensive one out of all of them. It'll have the range of a 300-mile range, where the Silverado is expected to have a 400-mile range, but the Ram 1500 is going to beat all of them, but with a 500-mile range. Now you can get from you can do some pretty long distances with a 500-mile range with that. And so, but again, the F-150 is probably still going to sell the most, just like it does anyways. And so, and it's going to be at a much more effective price point. So there's been a lot of attention on Ford Motor Company lately. And so with a lot of the analysts and whatnot and them talking and whatnot, there was an article, I think a week or two ago, saying how Ford could easily, gain 40% this year. And so I did the math, and that was about $30. Basically, it was saying that Ford Motor Company has a $30 strike price, not a strike price, but a target price for this year. And so it can easily do that, and especially the Ford F-150 Lightning is now configurable. If you go to the Ford.com website, you go on the F-150 Lightning. It used to be where you would just reserve it for $100, but now you can actually go there and configure it. You got your Pro model, which is like the XL model. It's your base model for $40,000. It comes 4-wheel drive. And I mean it's a neat truck. But that model is probably the ones that are going to sell the most, both the Pro and the XLT model, for all under $50,000. And so now you can pick and choose for the same price a gas truck or an all-electric truck. And so it's Ford has already announced that they're going to double their production, I think up to 150,000 Lightning models this year, which still isn't enough. There's so many people. If you haven't already reserved an F-150 Lightning, I would highly recommend that you do. It's only $100. And so and then once it gets here, probably 6 months from now or 9 months or whatever, even if you don't want the truck, that could be an investment, because you can easily turn around, sell that truck, sell it at an auction or a dealer, or privately for $10,000 over MSRP. Buy the base model for $40,000 and sell it for $10,000 over MSRP. You'll make $25,000 just like that. And so, and that's. But you drive that truck though, you might not want to get rid of it. And 0 to 60 in about 4 seconds. I mean, that truck really is a lightning. So going on down, we have AMD, and so on. I'm just not seeing a whole lot of unusual activity down here. A lot of this stuff is pretty common. So the next part of the bar chart website, you want to go to from most active options down to options volume leaders, because now we'll see out of the entire system the most active individual calls and puts. And so but the DTE, that's very important to be aware of, is the number of days until the option expires. So looking at this on a weekend, whether it be the Saturday or Sunday, we want to avoid anything with the 0, because it's no longer active. It's no longer valid. By tomorrow on Monday, it's going to disappear. And so we need to focus on the ones with the numbers. So Bank of America, going into tomorrow morning, Bank of America is the most active individual call and put. With the $50 call strike price, which is currently at $49.18, this individual call expires in 2 weeks on Friday, January 21st. It currently values around $73 per contract. And so we were just looking at the open interest versus the volume. Looks very, very good. And next one down is a $180 call strike price for Apple, which this and a $175 call strike price both expired this Friday, January 14th. Both had a very low open interest. One had the 27,000, the other had 25,000, but both have double the amount of volume. When we are seeing volume exceed over the open interest, we got to consider that as unusual and a massive amount of buying activity, because people obviously are very positive, very sure that Apple is going to exceed where it's at right now. It had a rough week last week, but the investors are really anticipating that Apple is going to do very well this week. It's going to bounce back. It's going to at least bounce around probably 175, 180 so far until further notice. And so that's a great sign to see, especially going into Monday, as we're talking about what Monday and Tuesday, Wednesday, and Friday is going to look like. Monday looked like it was going to be pretty good, and so where Tuesday did not, Wednesday looked like it'd be good, Thursday did not, and then Friday looks like it was going to be good or positive. And so this could be just one of those Friday strategies right before close. A lot of people probably bought a lot of calls on Apple, getting ready to sell Monday morning, perhaps, or maybe partially holding throughout the week. We'll just have to wait and see what this activity looks like. But this is one of the ways we can follow the money. Very, very, because with this, the value, this being $132 per contract, let's say times 51,000, and this is just for the individual contract. This would be like the total value of this would be a total of $6.7 million. So $6.7 million just for this one is betting that the stock's going to go up. That's a lot of money. And so you just kind of have to make it make sense to you. So the next one down, so that's a 0, so that don't count. That's 0, 0, 0. So the next one is another Apple. We have a put strike price. So we could be seeing some straddling activity. We see a put strike price, $170, the same expiration for this Friday, Friday the 14th. Open interest was also low on that one, 15,000, but we have a volume of 31,000. but the volume still is not as great as these other ones. So it's not quite pure straddling, where straddling would be more, straddling activity I would see more where the volume would be kind of the same. But it seems like that the calls are more in favor. Next one down is DVN, which is currently at just under $49, but we see a couple strike prices. We have a $50 strike price here, we have a $55 strike price there, but with a much longer expiration. But we also have a $40 call strike price, which is obviously in the money. And so, but you know, it could be selling activity as well. So sometimes we have to be aware of the volume and open interest, because if the open interest is pretty high and the volume is pretty low, lower than the open interest, this could be selling activity. People could be dumping this, maybe getting into something else. Maybe they are getting the dumping the 40, going with the 50. And so you know, we just have to be aware of that. The higher the volume is that passes the open interest, the better, I think, because it just provides more unusual buying activity, especially with this one, a KMI, which is currently at $17.27 with a call strike price at $18. That expires in February 11th, which is approximately 35 days from now. Each contract is about $22 a piece, but the open interest was really nothing. Only had 180. That's nothing. And now all of a sudden it had a massive amount of some kind of interest that is like 99.99% buying activity at that. And so there's something going on with KMI, yeah. So like I said, this is a great, phenomenal resource that is very valuable, and it's available to you guys for free. The next page, probably from this, would be the unusual options activity. It'll kind of help find things that we may have missed. But again, we found the KMI right here with the same stuff there. So that's on the top of the list. But we can also try to find other ones that have a pretty good decent volume amount. Not so much the low volume, like if it's a couple thousand. We need something that's closer to 20,000, 30,000 in volume with hardly any open interest. So we have IFF, which has a $155 call strike price, but the current share value is just under $142. But it had like no interest, but now all of a sudden it does for some reason. So, but this is, like I said, just really, really critical information, whether you're into stock options or not. It can really provide you some great stocks to start doing some due diligence, rather than going on social media or looking on news and other things, trying to find what stock should I invest in. Follow the money, follow the activity. Sometimes you can find things on here that's providing unusual activity. Like, for example, back before GameStop and AMC was manipulated, when GameStop and AMC was still around $3, $4, $5 a share, we saw them all of a sudden, they were on the unusual list. All of a sudden they were on the options volume leaders list. It was on the most active options list when normally they were not. And so they had some pretty good high strike prices. And so we can find things that are flying under the radar before they hit the news. Because when I found AMC and GameStop, on here, I was trading them and making a lot of money off of them before they hit the news, before all that drama happened, and all of a sudden it did. I was like, holy moly, what the heck just happened? And so, but this is how we can find that stuff without missing the boat and missing an opportunity. Follow the money, and this is one of the ways that we can do that. Let me see. I think that's about it. Anybody have any questions or anything? Oh, there was one other thing, kind of a new thing I wanted to kind of implement here really quick. Before we do questions, let me see if I have it in here. There we go. Okay. So I want to talk about cycles because, every year there's an algorithm, there's a cycle for things. Plus there's a 10-year algorithm too, and every 10 years we have the something catastrophic that happens, whether it's some kind of recession or whatever, something that allows politicians and investors to create massive dips. But ultimately this is kind of our yearly cycle, and right now we're right on the top, where everything's kind of peaked out here. And so we're with like number 7, we're capital goods, and then 6 is basic industry, 9 and 11, so that's energy, and 11, and that's when we're just talking, where you see a lot of news, oh, energy's been doing great lately, blah blah blah. Well, that's where we're at right now. We're right here on the top. What's next? So as we're coming down, now we have number 3 and number 1. So healthcare and consumer non-cyclicals are what is going to be on the news. So it's always good to be aware of what will be trending next, so that way you're aware of or that way you can plan ahead and know. So but technology is always a very popular thing, and so technology is always number 5. That's right in the middle. So that's really in the early bull season, which again is the spring season. So again, that is going to be your April, May, June area. And so it's just, like I said, it's very, and it happens just like clockwork, over and over, year and year after year. So this is just very important information, and it's just good for you to know. The more you learn, the more you earn, because it never changes. It's like this every single time. And so, but with that, I did post a couple other ones that are kind of valuable as well, because we have certain percentage things here. It talks a little bit more buy housing stock. So at least this one does provide you some advice, which is pretty phenomenal. Buy auto stocks, and then you have here buy low multiple tech stocks, because right we're on the bottom, 4th Federal Reserve easing, and then as it begins to come up, then you'll start profiting from those tech stocks as they're on the bottom. And so that should be around, but probably towards the beginning of March, I would think, as we start to get as we start to finish and wrap up this earnings season, as well as the yearly economic reports. The market will then start to look forward to all this stuff. This is what they're looking forward to. And so as it then starts to come up, we've already bought our tech stocks, buy the paper and chemical stocks, supermarket stuff, like retail, and whatnot. Buy stocks that grow businesses and stuff. Sell financial, housing, retail, auto stocks that we bought earlier over here, and then over here we can buy paper and chemical. It just kind of goes on and on. So, and this is in our announcement area, so that's there for your advantage, and you can click on that too. That's a little larger, a little bit more detailed. It's just highly valuable information. And so another thing, if you guys like reading and like books, go back to our group, go to the search little bar thing here, type in stock market a Bible. And so if you do that, it'll take you to a link right here. It's the stock market library. The more you learn, the more you earn. Click on that. It'll provide you access to our stock market library, which you have an endless amount of resources and information at your fingertips and for free. So you have day trading for dummies. These are all PDF files. You can download to your computer, desktop, laptop, your book reader, whatever you want to do. It's here. It's for you. There's also subcategories over here. If you want to learn more about candlestick trading, you can click on that, get access to that, and then learn from that. And so there's just all kinds of great resources here for your advantage. And so anybody have any questions before we wrap this up? Everything makes sense? Somebody says, Amit, you said, I have a question. If one straddle at the end of the day, next morning one is up and one is down, which would you sell first? So that is a great question. When you're straddling, which one to sell first, which one to sell next. So let's switch over to Webull really quick. Let's see if we can get into Apple. Let's see if we can go into a 1 minute chart, and let's see if we can use an example. Let's say Friday. So here's Friday. So early in the morning. So usually in the morning, at least within the first hour, you want to really use the 1 minute timing, the 1 minute interval for your graph. After the 1 hour, you may want to switch it to a 5 minute or utilize the two together. But so Apple was, I believe Apple was down that day, right? Yeah, they were hovering around 0%. But this is how you do it. So when you're straddling, you basically hold until it provides a signal. You kind of wait until it goes up or down first. So let it pick a direction first. It goes down, and then as we're down, the MACD bars are beginning to get shorter. Now we're back up here. This is basically our sell signal. It's time to sell the put, because now the stock's getting ready to go up. So if we sell the put, if the stock's down, we can now secure our gains on that, and our call may be currently at a loss. But we want to hold on to the call until further notice, because it's going upwards. So we sell the put, secure our gains, and then as it goes up, the call has now appreciated, and we can sell the call at or to minimizing the loss, or maybe now the call is at a gain. And now we've been able to gain from the put and the call. But as it goes down, it provided us the signal that we needed to get rid of the call. And if we want, we can buy back into a put. We can buy the put back here, even though we sold it down here. And now we can we want to, like I said, switch to the 5 minute chart, get the graph smoother. Let's go back to the Friday. So we bought up here, we bought the put, and now we're going down. We can day trade it if we want. We can sell the put down here, or maybe we can buy the call, hold the put, and if you're going to maybe hold it for the next day, hold the put, buy the call, counteract it. The call goes up, and you're making money on the call. Now your put, even though you bought over here, your put is now most likely at a 0% or at a wash, but you gain from your call. And then it goes back down. And now you're gaining now you just gained money on your put, and you're still a gain on your call. And then going in the next day, Monday, then you do whatever it does. But you wait for these signals to happen, and wait for those two signals to provide you your signals on when to get rid of your straddle. So it all usually happens within the first hour, or maybe two. Any other questions? Hi, Christy. I think I'm glad I was able to answer your question there. Any other questions? Or
yeah, Carlos, I have a question.
Sure.
So when you say A, B, C, D, the C point to buy would be normally after like an hour into market open, but would it make sense, more beneficial to buy a straddle at open versus at the C point? Because at the C point, maybe there's going to be less volatility throughout the day.
And that can easily happen, but there's a lot of time decay within the first hour, and it's really weird. A lot of people don't think of that, but the first hour of the time decay, what it's doing is trying to make up the difference from overnight. And just like on a Monday, Monday morning, the time decay, it tries to slowly absorb the weekend time. And so Mondays, and that's why a lot of traders that trade stock options don't usually like to hold anything throughout the weekend, because Monday morning, within the first couple hours, a lot of the time decay tries to kick in at that point, and then it starts to kind of mellow out. But Same thing for every morning. The first hour is trying to absorb a lot of that time decay from overnight. And so so part of the ABCD pattern too is to get the time decay depreciation out of the way, get the volatility part out of the way, make sure that it's a clear sign when to get in and to get out. And so stock market opened at that time, and then 1 hour is probably around right here. But like I said, sometimes that ABCD pattern can be a little sooner, sometimes it can be a little later. It just depends on what's going on. But you can see here though that it did provide the sell signal a little sooner, providing you a downtrend. Usually looks like about 35 minutes after the stock market opens. So that's usually a little sooner than normal, but like I said, that's why we want to really be aware of that. And but if you end up getting something shortly after that and it just kind of ranges throughout the day, you know, depends on the stock option, you could suffer a lot of time decay, because if the stock isn't moving anywhere, you're just going to suffer the depreciation until the stock moves a direction, and then it will become more profitable. But if you were to buy, you know, here and it basically it ended there, you would have suffered time depreciation, you wouldn't have gained anything. And that's why it's important to, if you're going to straddle, try to buy within the last 5 or maybe 10 minutes. And that way you have all that time depreciation and decay out of the way. And that way, when you get in and get out the next morning, you're working with the volatility, because a lot of times stocks are up or down 1.5%, 2% more or less. And that can have a big impact on the value of your stock option before the time decay really kicks in within that hour. And so that's why you want to try to get rid of your calls and puts within the first hour, but also to wait and see what things are doing at that C point after 1 hour, or during the 1 hour point, to see what's going on and to get in and out to mostly to day trade, not so much to get into things that you want to hold to swing trade early in the morning. Swing trade stuff should be more towards during power hour. That should be where we're looking for things on when to swing trade. But day trading is usually within the beginning of the day. So hopefully that makes sense.
Yeah, that was good. And then a follow-up question in regards to the Wells Fargo and Citibank and their earnings. Let's say, I don't want to misquote, but I think you said Wells Fargo and Citi are both on Friday. Thursday before close, is it recommended to get a straddle? Because we know, either one of those, it's either going to go up or it's going to go down depending on the earnings. Does that make sense?
Yes, it does make sense. And however, it is not recommended to do any kind of options through earnings, only before or after, but never through. And the reason why that is because for some reason, I wish it never existed, but there's something called IV crush, which is also known for implied volatility crush. It will crush the value on both sides, your call and put. Even if the stock, whatever it did, whether it went up 5 or 10%, which should be phenomenal in the options world, but for some reason, it may give you a little bit on one side, but it will take away a lot on the other side. It dramatically affects the overall value on both sides, and that's why it is not recommended to straddle or even do options on stocks unless you know for sure that it is going to go in a particular direction. Then bet on that particular direction only. Don't do straddling, but do that as a lottery play, as if you're if you're going to put the money in there and you're going to lose it all, because there could be a good possibility that it could, but as a lottery play where you're not, that you can live without that that money. But ultimately, do not hold stock options through earnings reports, because it's catastrophic. It sucks. Like I said, I wish there was no IV crush, but it exists. It's there. We have to know about it. We have to learn about it. We have to prevent it. And so, but that's the best way to prevent it, is do not hold options through an earnings unless you know like 99% or 100% chance that you know for sure it's going to go in the direction.
So let's say I'm following JP Morgan Chase and I see that, you know, earnings is coming 6:50 a.m. Eastern Standard Time on Friday. I'm looking for that earnings on Friday morning, and based off of what that earnings says, either positive or negative, market opens 9:30 Eastern Time. I'm looking at A, B, C. I'm looking for maybe a C entry once JP picks a direction.
Yeah. Yeah, that's basically what you want to do is see, because sometimes a company can still beat their earnings and revenue, but they still plunge, and then everybody's like, how come? You know, how come they had great news, but how come they're down? Well, a lot of times we can look at their charts. What if their price is already higher than, you know, anything else? Well, that leads into a clue that they the high price is already factored in beating their earnings. And so it's just kind of a weird system and rules and how all these characteristics and stuff. But if the price value is low and it's anticipated that they will beat their earnings, then that would be a good time to get in, maybe holding as shares or whatever, especially if they have a high percentage odds that they will beat their earnings. We can maybe buy a call on that. But by looking at something like this, like JP Morgan is already high, it's already at 167. The high point recently was 171. They may beat their earnings and they may go up 1% or may not go anywhere. It may just stay kind of where it's at now. But I think overall, you can obviously see all the low points are basically trending upwards. And as we're entering the bank season, you know, I think, plus, you know, it looks like it's a fresh buy signal here anyways, around 159. It looks like it has a pretty fresh uptrend indication here. We're at the first point here. There's usually, you know, at least, like I said, 3 or 4 more high points before it kind of reaches the top anyways. So JP Morgan looks like it's really, you know, just starting, but you know, but it's a good strategy to kind of, put all these little pieces of the puzzle together to kind of make a much more clearer image.
Thank you.
Yeah. Any other questions? Oh, so another gentleman asked, "Are we going to share the recording video?" Yeah, it'll take some time for me to render the video and upload it and all that stuff, but I will, as soon as I get it on YouTube, I'll be able to share it in Facebook, as well as our chat rooms. And some of you guys may have found this Zoom meeting. Let me switch over here. Some of you may have found our Zoom meeting just from our group, but maybe you're unaware of our chat rooms. In that case, we do have chat rooms, live chat rooms. If you go to our top of our group here, there's the chat rooms right there under the discussion mentor chats. We have I have 3 cryptocurrency rooms, learning center rooms for people that are new. Options rooms are basically the most active rooms out of all of them, the most popular things. And then penny stocks rooms are there. So this is critical, where we kind of work together as a highly effective team. So I will post a lot of this information in the chat rooms, everything that we went over, so that way you can download them, save it for your reference, print a lot of this stuff out, especially the patterns chart, the rules, the differences between the pro trader and an amateur trader. Anybody have any other questions? If not, you can always message me too on Facebook Messenger. My goal is your success. Don't hesitate to message me on Facebook if you ever have any questions or comments. But for now, any other questions before we close our session? Oh, good. Everything makes sense. All right, guys. Well, thank you very much for attending. You guys stay safe, make good choices, and I'll see you guys here pretty soon.